Over the last 2 years, what we have seen is global equity market valuations have gone higher, largely because of the loose fiscal and monetary policies, given that we had a big crisis such as COVID. And post that, what we have seen is a lot of these policies are being reversed, at least in the announcements since January. And we were seeing the equity markets being adjusting to these sort of news flows. At the same time, in what we saw last month is the geopolitical event that is happening across the globe, and especially in Europe, is also impacting commodity prices, and that's only adding to the volatility for a net importer of commodities like India. And to that extent, we believe that near-term volatility will continue, and while the valuations will basically adjust to the new normal of interest rates. Having said that, if we look at now at the medium-term outlook for a country like India, uh, we believe that India is in a very favorable macroeconomic situation. If we look at the demographics, the stable policies, forex reserves which are at a decent level, and also the currency that has been at a stable level in the last few years. The COVID crisis, India was able to get out of as an economy on an overall basis in a much better shape. While there were some sectors and parts of the economy that really got hurt, but on an overall basis, things seemed not so big impact. Also, if you look at government policies from a longer term perspective, they are all related to pro growth. We can call either GST, digitization, PLI, infra focus, or welfare schemes such as housing for all, which is basically creating more jobs. So all in all, we feel that over the next few years, if we look at the medium term, India will have a higher GDP growth, and that will result in higher growth for corporate India as well as more investment opportunities for the market. We believe that aggressive hybrids, balanced advantage, as well as multi-asset funds are actually quite attractive for a larger set of investors. And that is obviously visible in the kind of assets that these fund categories have garnered over the years. As you know, aggressive hybrid is a mix of 65-80 equity and remaining debt, largely for an investor who is looking for a slightly higher mix of equity, but not complete exposure to equity market. Then there is balanced advantage, which goes across the spectrum of equity and debt, where the fund manager decides for the investor, and it's largely an investor who is probably new to the market, is afraid of taking those decisions, does not know how to take those decisions, and hence the fund manager does it for him or her. And similarly, multi-asset funds add another asset class. Most of the cases you will find fund houses having equity, debt, and probably gold or maybe real estate, international equity, and other such asset classes, which kind of give a boost to the investment, and more importantly to the risk adjusted returns for the investor. They kind of different categories of funds, and especially if we talk about the aggressive hybrid funds also, they have a set mix of equity and debt, which kind of help the investor decide based on what goals they have. So what based on the sort of objective, they can take a mix of equity and debt in various proportions, and they don't need to do it on a regular basis. The first big advantage I would say is rebalancing, which is on an overall basis, if we see these asset classes, equity, debt, gold, etc., they move in various directions over a period of time, and hence the optimum mix of that fund might actually keep changing and might not meet the objective if not rebalanced. So that's the one big advantage, where every, let's say, 1 month, the fund manager ends up rebalancing the fund, and hence they kind of get the right kind of mix that what they envisaged at the beginning. Second, if an individual tries to do this, there will always be an implication in terms of operational hassles. There will be implications of tax in terms of long and short term capital gains. So obviously that is another hassle that is taken care of. And thirdly, I think if we do it on a disciplined basis over a period of time, and whether when both of these separate asset classes are managed, both as individual portfolios as well as a mix, it can over a period of time even beat the for example, an aggressive hybrid fund category can even beat overall market returns if done on a disciplined basis. So hybrid funds, we believe, are kind of all-season funds. These funds help you take advantage of equity and fixed income investing through a single fund, basically thereby managing attractive returns for the funds. It's easy to have a portfolio of 5 to 10 different portfolios or different schemes in individual's portfolio based on different purposes, rather than having different schemes for the same purpose. So for example, having 5 equity funds and then 5 debt funds, which kind of on their mix individually they might do good performance, but on a mix might not give the kind of returns that the individual is expecting. So if they have different purposes or goals of investing, they might actually have different categories of hybrid or individual funds in their portfolio of various categories, which can actually give them a better sort of investment experience. So as you know, Axis as a fund house has been known to follow quality and growth as our core approach, as our core investment philosophy. It has been proven that over a period of time, quality investing helps to create wealth in the longer term, especially with the downside protection that it gives us. So as customers want a peaceful investment journey of wealth creation, this exactly matches with the overall offering of Axis Mutual Fund. Another aspect, that I also mentioned a bit earlier, is that we manage these hybrid funds, these multi-asset funds, as separate portfolios, and the equity and debt component of these funds are managed actively by individual fund managers who have a mandate of managing these funds on an individual basis, and they are actually evaluated on that basis. Every fund has a specific objective, and as we mentioned, individuals need to match their own investment goals and risk appetite to these funds. But instead of managing individual asset class based funds, these goals can be addressed by putting them together in a hybrid funds. The advantage of hybrid funds over individual funds is regular rebalancing. As asset classes move differently at times, the optimal asset mix can get disturbed, and this gets addressed automatically by the fund manager based on the construct of the hybrid fund. While if the MFD does it individually, they will have to actually do this manually. Plus, as we mentioned, even in case of a mutual fund distributor, they will also have to go through the operational hazard of managing these short-term and long-term capital gains, just for the regular rebalancing that they do for their individual investors.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.